Why would you want to buy a put option? If you have kind of a neutral or bearish opinion of the market, you think the market's going to go down, buying a put option is a great way to make some money. Hello traders, welcome to part 8 of our course Options 101. We're going to talk about buying and selling put options. If you recall, put options operate opposite of call options. You buy a call, you buy shares, you buy a put, you sell shares, but the trading implications of that activity are a little different. So I want to go over what happens when you buy or sell puts, and that is this 8th part. We have 2 parts left after this. So let's get into it. Before we do, this is for educational purposes only. We are not financial advisors. Please pause and read if you have not done so already. So let's dive into it. First, why would you want to buy a put option? Well, if you have kind of a neutral or bearish opinion of the market, right? You think the market's going to go down, buying a put option is a great way to make some money. The options contract will gain money as the market goes down, and you can always sell that option contract for more than you paid for it. So that's one way to speculate. The other way is for insurance, and I'll go over an insurance example. We can buy a put as a hedge for an existing position or for a specific need. I'll discuss that in just a second. So similar to buying call options, put options, the chain shows the price of that option based on the expiration date, the strike price. You just go over to the ask column. This is what sellers are willing to sell their call or their put contracts for. In this case, $1.33. This represents 100 shares. So $1.33 times 100, you would pay $133 for the $190 put contract on Apple expiring July 21st. All right, broker software shows this on a per share basis. So please make sure you understand how many shares you're dealing with as a multiplier, right? And because these stock option contracts deal with 100 shares, we multiply this times 100. Just want to remind you to keep that in mind when you're looking at options prices. What happens for speculate? If I'm a speculator and I buy a put, and I've got an example, here's kind of a profit chart based on stock price, and we're looking at the $40 strike put contract, and the cost of that is $3 times 100 shares, so we're going to pay $300. And remember, a put gives us the right but not the obligation to sell 100 shares of this stock. So we're buying a put at the 40 strike, and if the price of the stock increases and goes up, we can only sell it for a maximum of $40 based on our contract. Well, we would lose money because the stock itself is going to be worth more. So our max loss at that in that instance, if the stock goes up, is $300, right? The price we pay. Whenever you're a buyer of an option, your defined risk is what you pay. So, but as the stock price decreases in value, so the stock goes down, you'll see that this line is sloping upward. This represents the price of your option contract. You will have an increase in your profit. The contract price increases. So if at expiration, this is kind of the break-even point, right? At $40 a share, that's $4,000. You're paying $300 for that. If the stock price drops to 37 and you can sell them for 40, you can sell them and collect $4,000 minus the $300 you paid. That's $3,700. The stock is trading for $3,700. You break even. There's no profit in that trade. So the stock would have to be below $37 in order for you to make money. And if it is, that contract is worth more than you paid for it, you could just sell the contract back. Now, that's one way that you can speculate. Now, how do we use these for insurance? Well, let's do an insurance example. So let's say you have an upcoming expense, and you're an investor. You've got some stock that you use. You've had in your portfolio for a long time, and let's say you want to buy a car and you need a down payment. You need a down payment of, let's say, $3,700 on this car that you want to buy. And so you've got some stock and you want to guarantee that you can sell that stock for $40 a share no matter what. Or you want to guarantee whether the market has crashed, the stock is trading at pennies. What can you do to protect yourself? You can buy a put option. So if you could buy that same put option at $40 a share, strike price is $40, you pay $3 or $300 total for that option. That gives you the right to sell your shares at $40 per share no matter what the stock price does. So your insurance policy guarantees that you're going to receive $40 per share for your stock, even if it's trading at pennies. You had to pay $3 per share or $300 for that, right? So that's a net of $3,700, which guarantees you're going to have your car down payment. Now, if something happens and the stock goes up just a little, insurance isn't meant to make you 100% whole, but you wouldn't want to sell at 40 if it's trading at like 45 or 50. You're going to be out a little bit money, but you're going to have the money you need from selling your stock regardless. There's a little bit of a gray area in there, but despite that, this is kind of the mechanics of why you would want this as an insurance policy. You want to make sure you have enough money from the proceeds of your sale, so you can just buy a put to protect your position. What about on the sell side though, right? Because we here at OptionGenius, we prefer to be on the sell side for most of our trades and most of our strategies. So how does that work? Well, when we sell a put contract, or when we're the writer or the seller, kind of like the insurance company, we're saying we're willing to buy that $100, that 100 shares from you at whatever price. So let's use the same example. The person sold or bought the $40 put contract, we sold it to them, and if the price of the stock does not drop to the strike price of the contract, well, we don't have to buy the stock. So let's say the stock's trading at 42 or 43 or 44 or 41 at the expiration date. Well, there's no reason somebody would want to sell it at $40 a share if it's trading above that, because they'd be losing money, instantly making money on that stock. We're buying it at 40 and it's worth more than that. So they're going to say, no thanks, I'll keep my stock. We get to keep that $300 premium that they paid, and we made some money. Now, if the stock does drop below that strike price, that seller is going to want to take advantage of their insurance policy. Hey, I need to get my money, so we get assigned those shares. Those shares are put to us. We bought those shares at $40 a share. The stock price drops below 37 though, we start to lose a little bit of money, but it's unrealized losses, right? So we collected some money at $40 a share that effectively lowers our cost basis for those shares, which is nice, right? We paid $4,000 for the stock, but we collected that $3 in premium. So really we're only out $3,700, right? So we sell the 40 contract, we collect the $300, the stock is trading above 40, we keep the premium. At 40, we're going to get assigned and we keep the premium, lowering our cost basis to $3,700, right? We can consider this a discount. This is something we keep track of on our own end. It's a common thing that investors do. Warren Buffett's very popular trade strategy is doing this to get into positions he wants to build. So he'll just sell some puts, collect some premium, and get assigned some stock. It's a pretty nice thing to do. And we talk a little bit more in detail about how to organize these types of trades in our strategy courses. So I hope all of this made sense and why it would make sense to sell a put if you're looking to purchase some stock. You want to buy it at a discount. It's not really discounted. It's at a price that you're happy to pay for it, and while you wait for it to get to that price, you're collecting that premium. That's some income you can use to buy some more stock. All right, so as a recap, buying calls is bullish. This is a recap for both parts 7 and 8. Selling calls, you can expose yourself to unlimited risk. If you don't own the stock, you minimize your risk by owning the stock. It's not completely eliminated, but you minimize it. Buying puts can be speculative, but also act as insurance or a hedge for a position in a portfolio. And selling puts is a great way to generate income while waiting for a stock price to reach a level that you want to buy it at. Very popular thing to do. All right, so that's it for our discussion of options. The next couple of parts got some surprises for you, some information for you, some things to help send you on your way. But again, I hope this has been informative, and if you have any questions, please make sure to email us. I'll give you that email address here at the last part. But thanks for watching part 8. I'll see you in part 9.